Do you wish that all things wealth and finance were much easier to understand and not presented by a bunch of beige cardigan-wearing geeks? Welcome to the Clever Investor Podcast, where we're dishing up the easiest to understand finance program served in bite-sized chunks, so your brain will thank you as your knowledge grows. Hosted by the brilliant Owen Taylor, a multiple award-winning expert with a glorious knack for explaining the complex world of wealth in the simplest of ways.
Hello, Clever Investors, and welcome back to another show. We have a very special guest in the studio today. It's Dr. Tony Nguyen, who is an absolutely fantastic mortgage broker. I've known him for many, many years. He's very passionate about what he does, which is a term that's often bandied around quite loosely, but this guy really is. He's got an amazing social media presence, so I'll put links to that. And what's this doctor thing at the beginning?
Yes, Owen. So thanks for having me here, and hello, listeners. The doctor thing came from my PhD. I graduated with a PhD in medical sciences back in 2013. So in the past, I used to be a HIV and hepatitis researcher.
And so how does that then link into helping people with their finances?
Long story short, I went into medical sciences with this idea of wanting to help the community.
Yeah.
I didn't know how, so I figured, all right, let's do science, because I was more inclined to biology back in high school. Mm-hmm. But as soon as I started my PhD, I knew that I didn't want to do research. But I had this pride in myself where I felt like I started something, I wanted to complete it. But as soon as I finished my PhD, I knew I needed to do something else, because research wasn't really for me, or I wasn't for research.
I suppose the ironic thing about that is you had to put a lot of research in to actually get the PhD.
Yeah, absolutely.
So
absolutely.
You know how to not just study, but you know how to then go and source and analyse things.
I'm actually very grateful for my PhD. A lot of people used to say, oh, that's a waste of time. You spent 10 years in science and then you fobbed it off and now you're in finance. But the reality is, I think the reason why I love mortgage broking now is it's to do with the original purpose of why I did my PhD and became a scientist. I had this, fantasy of wanting to win Nobel Prizes and discover something amazing, right, and help, the world. But now I've gone into a sector where I can help individual families one at a time, and that's just as rewarding, if not more rewarding, to be honest, because that feeling is tangible, that you did something for the client that benefited them.
So we got to talking the other day about the fundamentals that we all learn about when we start into the finance world, and it's the 3 C's of finance.
So the 3 C's of lending is not a concept I came up with. It's actually, gospel in the industry. When a lender looks at you for approval, they look at these 3 components, not in isolation, but together, okay? So the first C is capacity, then it's collateral, and there's character. When we lodge a deal as an application to the bank, we make sure that we have the information there to satisfy those 3 criteria.
Would you lodge a deal if it was missing any of those 3?
No.
Okay.
It has to all work in tandem. So, for example, one common scenario or question that I'll get is, hey, Tony, I've got $1 million savings. You reckon I can borrow another $1 million to buy a $2 million home? I'll go, okay, yeah, well, so what do you do for work? And they said, oh, nothing. I don't have a job, but I could service the debt. Okay, how? I think, I've got cash coming here or whatever. And I said, look, if you don't have any legible income that will satisfy the lender, it doesn't matter whether you have $1 million deposit or not. They won't lend it to you. Okay. And conversely, someone might be on a good income, but if they don't have any savings to contribute to a new purchase, then again, the lender won't lend to you.
If your client comes in and they're missing any one of those fundamental 3 C's, you're not just going to go and lodge it to the lender.
No. So that's what we call a preliminary assessment. So when a new client or an existing client comes back, we go through the same procedure. Okay. What does your character look like, by the way, which is determined by your credit score. So we'll do free credit checks for you just to see, what your credit score looks like or what your character looks like. And before going, character refers to, if I'm going to lend you $1 million, I need to know that I can trust you to pay me back. Okay. So when we look at someone's credit score, we're looking at, how many loans have they applied in the past, whatever loans that they do have, are they paying it on time, and whether there's any history of misdemeanors such as defaults or, bankruptcies or anything like that. But presumably, if your credit score is relatively good, assess your income and your ability to service a new debt, and then we'll look at, what's the collateral piece, how much savings do you have, or how much equity do you have in your property.
If you've been doing the rounds straight to the banks and just sort of throwing your applications in to see if it would stick, that's actually going to bring down your character.
Yeah, look, it won't positively impact your character. It's not the end of the world if you lodge, 1 or 2 mortgage applications, because the type of credit application actually is important too. So, for example, it's not unusual for someone to maybe lodge a loan with a bank for a mortgage with 1 or 2 banks. Personally, I wouldn't do it. And sometimes when people do that, it's probably because they're looking for a better offer, So that's kind of acceptable. The danger is when there's a history of credit applications for credit cards or personal loans, particularly personal loans under the value of $2,000 or $3,000, because that kind of indicates that if you need funding of that amount, you're probably cash strapped.
I had a bit of a show about this a while ago, but what about these payday loans? How are they?
Yeah, so that's exactly what I'm referring to. Payday loans where you go to lenders that will lend you $2,000 or $3,000. That's not really good. That if that comes up on your credit score, then that's a red flag for me. It's not a dead end, but it does warrant more questions and a deeper conversation.
Part of what you're doing before you're putting it together to the lender is you're vetting this out.
Absolutely.
And you're then going to decide and tell the client as well whether you think it's a good time to put the application in now or later.
Yeah, or it dictates which lender we're going to go to.
Yep.
Yeah, so multiple lenders on each mortgage broker's panel. And our job is to find that right lender that's suitable for you.
Yeah. It's the if somebody has had some of these sort of payday loans, and they've had a few of them, which is often the case. People get into a little bit of a rut with this. You said before that it's not the end of the world.
No, it's not, because when I say the 3 C's of lending, we're not looking at them in isolation. We're looking at it together. So if we can put together a strong application, have mitigants to counter the reasons why there's so many payday loans. And you got to remember, a lot of people have credit cards and they use it, but they use it pretty smart. It's not unusual for someone to use a credit card to collect points, and then at the end of the month, they just wipe off their balance. Having a lot of debt is not bad per se. It just depends on what the overall picture looks like. And that's what our job is, to determine that overall picture and the suitability to send a loan application.
When you're putting the application to the chosen lender, you are then telling them the story behind all of these statements and all of these reasons why. Okay?
Correct. So we have a real life example, a recent one. Okay, we have a gentleman who's in IT, earns good income, very good coin, passes the capacity test. We're doing a refinance, cash out so he can buy another investment. So he has that equity / collateral there, but the major lenders knocked him back based on his credit score. And when we did a bit of digging, it turns out that 4 or 5 years ago, he had a series of credit card applications which didn't look favourably to that major bank.
Right.
So we've taken the deal to another lender. Right. They look at the strength of the application in itself, and they approved it.
I had a client many years ago who she was a night shift nurse. She had 60 inquiries. Oof. Actually never gone ahead with any of the finance with any of them.
Okay.
So I just had to printed it out and just went through and just went, did not proceed, a little bit of a story against each one. And she got good capacity, she got good character and all of that. She just didn't know what she was actually doing and how it was affecting her credit file.
See, a lot of people, a lot of these websites for banks with credit card applications or personal loans, they always have this link that says, apply here or see what your borrowing capacity is. And what many people don't know is when they put the information there, there's a soft credit check happening in the background, and it registers as an inquiry. The T's and C's are so small that you don't know about it. So someone like your past client wouldn't have known that, it would have affected her credit score as such.
Let's talk about the other C then, capacity. Tell me about that.
Okay, capacity is relatively straightforward, and it's probably what everyone wants to know. How much can I borrow, Tony? Well, the short answer to that is your borrowing capacity is determined by how much income you're bringing in, whether that be your wages, your business, or your rental properties, minus your living expenses, plus any other debts. So generally speaking, the bigger that gap, the bigger the borrowing capacity.
And everybody should just go online to those bank calculators and just work out their capacity then, yeah?
Look, they can go on there. If they have an itch to scratch, then by all means do it, yes. Just refrain from answering the Autobot text message because you might get roped into a call that you might not want to answer, Look, those online calculators are a good guide, but here's the thing. Each lender that we have on our panel, they calculate borrowing capacity in different ways. So that's why you can often get a different result from one bank to another.
It's never too early to actually start that conversation because there could be an opportunity. Your neighbour's trying to sell that place, which is probably worth about $4.5 million now. So you missed out on that place.
Yeah, I'm crying. Here's one thing I learned about research back in the scientific days is that research never ends. Once you look up something, you'll come across a concept you might not know, then you have to look into that even more. And then you keep going so far deep in that you forget the purpose of why you started this research. And what many people find it difficult to comprehend is, okay, now what does it really mean for me? So that's why I feel, like you said, call your broker. Private broker is the best person to call because a bank might give you a different result, right? A broker would be able to canvass all the different lenders out there and give you a range of borrowing capacities. So which lender you will go to it depends on what the actual overall goal is. So for example, when we talk about the 3 C's of lending, you might have a borrowing capacity of $1 million, right? But if you only got a deposit of $50K, your purchase price is not going to be $1 million. It's going to be a lot lower than that. My clients, they might have a borrowing capacity a lot higher than what the loan application is for. And that's because it's tied in with the deposit piece and the other pieces as well.
Yeah, and then sometimes it's ran the other way. Yes. You've got a big deposit, and like I've got a friend of mine that owns probably a $1.8 million property in the inner west of Sydney, but her income for the last couple of years has been less than $50,000. So she's frustrated because she's got lots of equity, but she hasn't got the capacity.
Yeah, and that's exactly right. So she has a bucket of equity, right? But because her income's a little bit light, her borrowing capacity is going to be light. So her expectations has to be managed accordingly. So as I said before, borrowing capacity is a function of income minus expenses and debts, right? A lot of people think, Tony, I earn $200,000 a year. All right, how come my borrowing capacity is low? The reason is what your spending habits look like. If you're earning $10,000 net a month, but you're spending $9,000, right, then the bank's not going to look favorably upon you, because they feel that your standard of living is a bit too high and therefore your ability to service a debt is reduced. You can go back to the lender and argue, I'm only spending lavishly only because I don't have a commitment at the moment. I'll cut back on expenses when that happens. Well, if that's the case, our job is then to find the right lender that would accept a reasonable explanation like that.
They probably can't be as picky then with what the pricing is going to be, because the risk is higher. So any lender is going to price that risk higher for them. So they...
Yeah, look, what we'll do is we have a further discussion, right? We make sure that the number one rule of lending before 3 C's of lending is that, is the loan unsuitable to the client? Let's rephrase. we got to make sure that the loan is not unsuitable to the client. So we don't want to put a client in a position where they may experience financial hardship, right?
Yep.
So you don't want to get a loan for a guy who has a family, he has, minimum expenses to cover, and then you detect that if he took a loan, he will struggle, right? He or she will struggle. So that's one thing we make sure we don't do, right? That's a law as well. But, it doesn't matter what the government says. I have my own moral code. I don't want to see people like struggling and being put into positions where, they're not going to be better off, right? But in a scenario where, if their paperwork doesn't suit a particular banking criteria, then we'll look for other options who may not look at those paperwork.
Right. So tell me about the last C then, collateral.
Yes. Okay. So when we borrow money to buy property or refinance property, generally it's significant, right? If the median house price in Sydney is 1.3 now these days?
We're getting closer to 1.4. Yeah.
Okay. All right. So 1.4. So an 80% loan value of 1.4 works out to be just under 1.2. So that's a lot of money. The bank has to question whether they can trust you to pay that money back. Mm-hmm. So first they tick off the character piece. All right, he's got a good credit score, he pays his debts on time. Cool. Then they look at the capacity. Okay, he earns a reasonable amount of income. He spends at a comfortable level. I think I think he shows capacity to pay. Then the third part is then what if for some reason you might have lost your job or you couldn't work anymore and now you don't have a capacity to pay? Then the bank wants to get their money back somehow, right? So in mortgage lending, we use what is called securities, and the securities are the actual property. So the bank will have to go out and value the property and make sure it's worth what you claim it's worth, right? And then they'll lend you a certain percentage against that value of the property. So that's what we call the collateral piece.
Right.
Yeah.
Okay. And so it's a whole episode all on its own on just bank valuations.
Yeah.
And I used to have a small part in my office out the back where I'd go and bang my head against the wall. To do with bank valuations. So we're not going to dive into that now.
When we have the conversation with clients about bank valuations, we have to set the expectations. Generally, when it's a purchase, right? So someone has bought a new property and now we're trying to get a loan for that. More often than not, the valuers will always come back at the contract of sale price, never more, and maybe sometimes lower. So sometimes clients will always say, I bought that house for 1.065. I'm so surprised that the valuation came back exactly at 1.065. Well, the reason is because that's what the market has said it's worth, which is you, the buyer, right? So it's never any more than that. There can be instances where someone might have overpaid according to the valuer, right? Yeah. And in those instances, we have to work out how to mitigate that issue. So more often than not, in a purchase transaction, the valuation comes back at the contract of sale, right? It's different when it comes to refinances, right? So refinance is when you're changing existing lenders, right, for an already owned property. Now, a lot of people think that, their property is always worth more than what the valuers always value it at. And that's where we really have to give them that expectation. Yeah. We ask the question, okay, Owen, what do you think your property's worth? Okay, I'm going to note this down. And when we order the valuation, I'll put that figure down. But please understand, the valuer has his general way of valuing things. It may come in at the same value you have, and it might come lower, or it might be even higher.
Thank you, Tony, for coming in. You got a world of wisdom there. It's always great hearing you talk, and as I said at the beginning, the passion and the way that you just want to do things properly for your clients. It's no wonder you got such a great little following of people there. So we'll get you in again sometime.
Yeah, sure. I'd love to be back. Yeah.
Thank you ever so much for coming in. I'm going to put your details in our socials here, so if anybody wants to get in contact with you, just in case their neighbour offers them their property and they're not ready. Thanks again, mate, for coming in, and we'll see you again on the Clever Investor podcast.
Wonderful. Thank you, Owen.
You have been listening to the Clever Investor podcast, proudly sponsored this week by Blue Wealth Property. Are you ready to start a new investment journey? Get in touch with the industry leaders. Blue Wealth Property. property. Blue Wealth have a proven track record in using research to identify growth markets, and Blue Wealth have supported thousands of Australians to buy the right property in the right market at the right time. Go to bluewealth.com.au.